Hello and welcome to our event Securing Your Future here at The Spectator and kindly sponsored by Netwealth. I'm Kate Andrews, Economics Editor here at The Spectator. When COVID-19 cleared out our diaries last year, it also altered countless retirement plans. Some timelines have sped up due to an increase in redundancies for the over 55s. Others have been stretched as an unsteady stock market took its toll on some pension pots. So has retirement planning changed permanently? And will the pandemic demand more flexibility out of retirement plans? Joining me today to discuss all of this and more, I'm joined by Martin Vander, business editor at The Spectator, and Charlotte Ransom, CEO for Netwealth. I'm going to start by asking both of them for some of their comments on today's topic, about 5 minutes each. Then I'll ask them some questions directly. We'll have a bit of a discussion, but we will be sure to leave plenty of time to get to your questions in the audience, which I will put to Martin and Charlotte. Some have already been submitted, but you can submit as you're watching tonight. If you'd like to ask a question to the panel, do so by writing in the text box on our website or by emailing events@spectator.co.uk. So let's get right to it and not waste any time. Charlotte, let's start with you.
Thank you, Kate, and hello, everyone. As you heard, I'm Chief Executive of Netwealth, which is what I would call a modern wealth manager. We launched 5 years ago, really with the idea of combining the best elements of traditional wealth management and bringing together much more modern technology to improve the overall service. And I'm delighted to be joining the Spectator this evening for tonight's discussion. We're here to talk about planning for retirement amid uncertainty, and the pandemic certainly focused everyone's mind on personal finance in a way that possibly hasn't ever been the case before. This is arguably a good thing, since many of us prefer to leave financial planning at the bottom of our to-do list when it really does deserve some attention. The recent events across global markets and economies may have been particularly worrying for those approaching retirement or in retirement, since there's obviously likely to be less room for manoeuvre. But what we've seen is that for many investors, any damage has largely been undone, and portfolios have actually performed well since the depths of the crisis last March. And it's a good reminder, I think, of why staying invested and not panicking remains true. It was Warren Buffett who said the stock market is designed to transfer money from the active to the patient. And that's something that I feel is definitely the case. Retirement might have taken a variety of paths as a result of the pandemic. So for some, it has become more attractive with a focus on enjoying children and grandchildren, and perhaps also travel once it's allowed again. We certainly now know how much all of this stuff means to us since it was taken away. But maybe retirement is less likely or achievable for others. Their pot may not have been restored to previous levels, depending on where it was invested. And there may be concerns about future investment returns being insufficient to support a long retirement. Or maybe there are younger generations who are more dependent on you now than they were before. Fortunately, for those of us who do need to stay and work for longer, and we know that it will be the case for some, work setups have just become a lot more flexible and probably favour older people, given their home working arrangements are more likely to be better than they would be for younger people. As the chief executive of a wealth management company, retirement has always come up as a key topic for clients. Whether we need to work for longer, or indeed we want to retire early, if markets are experiencing greater volatility, or for example, there are threats such as inflation, or we're in the process of planning for intergenerational wealth transfer, all of these make a difference when it comes to retirement planning, and boils down to one main area that bothers all of us, and that is affordability. This is what clients want to discuss with us, and it's also very much reflected in some of the questions that readers sent to us ahead of the panel. So how can investors know what's feasible in retirement, both to support their lifestyle and also to allow them to provide for the next generation or to fulfill philanthropic goals, for example? This question becomes all the more poignant when thinking about future market returns and the potential for them to be lower than they have been previously, and therefore potentially less able to support a long-term retirement plan. But it's important not to forget we are talking long-term. So there was a questionnaire that was asked of today's listeners, and 70% of you are 65 or younger, and another 20% are between 65 and 75. It's critical to remember that you're planning over a long period, both in the accumulation phase and also accumulation phase during our working lives, and then also during the drawdown phase. And given the length of time we're talking about, periods of market uncertainty and volatility absolutely should be expected. but remember, they can also be tolerated over the course of a decade or multiple decades. One thing's for sure, though, we know from many different sources that a big chunk of the working population is focused on this question of when and if they can afford to retire. And it's great to be discussing the subject with you this evening.
Thank you so much, Charlotte. Martin, over to you.
Thank you very much indeed. Very nice to be with you this evening. Nice to be doing this with Charlotte Ransom. I'm the business editor, long-time columnist in the Spectator. And when Kate asked me to participate in this, I said, well, you do realize that I am of an age that I really probably ought to be retired. I'm in receipt of a state pension. And so looking at this from that end of the telescope, as it were, and she said, that's okay, Martin, you can speak from lived experience. So I'll take that as a compliment. And tell you that, for example, if you had met me 30, 35 years ago, I was working for a bank. I thought I would probably work for the same employer for the rest of my working life, which would last probably until I was 60, when I would retire on a defined benefit pension that would comfortably look after me for the rest of my life. Well, all of my circumstances changed at some point. All of everyone's circumstances are likely to change, more so now than for that generation of long-term employment with one company and so on. Many things, that happened then are not going to happen again. So where does that take me in beginning to think about this? What I think is retirement has to be addressed in a sort of holistic framework approach. That is to say, whether you're in your 30s, 40s, approaching your 60s now, you have to ask yourself a set of first questions, really. How long do you want to work? Do you want to do something else? Do you want to travel? Would you rather work, as long as you're physically fit to work? How is your health? Then what assets do you already have? If you own a house, that's tremendously important. If you own, more than one piece of real property, that's an important part of your asset portfolio. Do you have any pension entitlements from past employments that are already part of the formula? What obligations do you have? You have obligations to your offspring that you have to consider, the intergenerational question. You may have obligations to your parents. People live a very long time now. You may need to fund care for an elderly parent long into your own early old age and so on. So your aspirations, your obligations, all of these things have to be considered. And a vital aspect to anything about retirement planning has to do with tax. So there are a number of tax advantage things you should be doing, whether that's stakeholder pension, whether it's building up an ISA portfolio. But what I would suggest to you is that building up all the tax advantages you can have from the point at which you're able to start saving is by far the most important aspect of your saving plan. And in a way, it's a lot more important than investment performance. Now, I'm speaking in the company of a distinguished wealth manager who can talk about investment performance, I know. But what I would say is in this hierarchy of issues you have to consider, actually how your funds perform against the markets and so on, it's interesting, but it's not the crucial thing. The crucial thing is know what your expenses are likely to be, know what your aspirations for when you're going to stop working, what you'd like to do for the rest of your life and so on, know what your obligations are to your family and all of that, and plan the whole framework. And then within that, actually, the performance of the investments is another topic, but it's not the top of the agenda. I'll pause there.
Well, thank you so much, Martin and Charlotte. Martin, we're delighted that you are with us tonight, so thanks for being here. I'm going to jump right into questions, some pre-planned that have been submitted from the audience, others that I have for the two of you, and then we'll go to some of the live questions that are already coming in. And just a reminder to our audience, if you do want to submit a question while you're watching tonight, especially if something that Martin or Charlotte has said has sparked your interest, you can do so through the text box on our website, or you can email events@spectator.co.uk. So, Charlotte, it's impossible to speak about pensions and retirement and savings now without paying some kind of acknowledgement to the pandemic. And I have some figures in front of me. December last year, 13% of over 55s said that they were expecting to delay their retirement due to the COVID-19 crisis, and 52% of all UK adults said they were concerned that the crisis meant that they would not be able to afford the current lifestyle or the lifestyle that they aspired to in retirement. So how has the pandemic changed how people are broadly thinking and feeling for retirement and their financial health more generally?
Yes, thanks, Kate. I mean, as I mentioned in the introduction, the main question that keeps coming up, and it's really what you're talking about, is just how affordable is retiring now or in the future? And I would definitely extend this to overall financial health. The combination of really volatile markets, high asset prices, and the potential for inflation are all ingredients that focus the mind. But actually, many factors remain the same as they always have been when working out this key question around affordability. And to do this, you need to put together what I think of as a sort of personal balance sheet. And it's sort of really what Martin was talking about as well. So first of all, you need a good idea of what your outgoings and expenses are, and if any of them are likely to change. So for example, are you supporting a child or a grandchild now that perhaps you won't be in the future? Or what sort of income are you likely to need over time? And again, this can easily vary. So there will be probably higher costs in early retirement when hopefully, everyone can travel again and you can spend some time in theatres and restaurants and so on. Then potentially costs are lower for a while until they rise again to cater for possible ill health later, much later on, towards the end of retirement. Once you know your potential cash flow needs, you can work out if the pot is likely to be sufficient for them. And there are a number of variables that will affect how long that pot might last, or importantly, what cash flows it can support. And this is where I like to talk about what I call controlling the controllables. So there are a number of things we can't control. We can't control inflation. For example, we can't control longevity. And this is an interesting one because people always underestimate how long they're going to live when they're thinking about how long their pot needs to last. I mean, average life expectancy is now 87. There's a 25% chance of reaching 94 and a 5% chance of reaching 100. But if I could count on one hand the number of people who think that they're going to make it beyond 85, I probably wouldn't use up all my fingers. It's unbelievable. Now, the nice thing is, though, that we can model to see the impact of both of these things, for example, longevity and inflation. We can also think about market returns. Now, we can't control market returns, but there are areas that as investors we can control. Firstly, you can influence your own market exposure by actually being diversified and staying invested, very importantly. You can also make sure that you make use of all the tax breaks that the government gives you. So obviously the main ones are pensions and ISAs. Martin alluded to them earlier. And done in the right way, these can build into very substantial tax efficient pots over time for you and the rest of the family. Then lastly, and really importantly, you can control costs, or at a minimum, you can know precisely how much you're being charged. And that might actually make the largest difference to the size of your retirement pot. And it's critical to understand. I'm often really amazed by clients who tell me that an additional 1% in fees doesn't seem that much. The reality is so different. I mean, 1% excess in fees amounts to 14% of your capital over 10 years. And since we're talking about retirement, we know that this is probably a multi-decade topic. So if you take an example of £1 million, that would be £140,000 paid away in unnecessary fees over 10 years. And you can take off a naught or you can double the amount, but you get the overall idea. Fees are really instrumental to long-term financial health. So we use tools to help factor in these different controllable and uncontrollable aspects so clients can see whether their retirement assets will be sufficient. And it's a great way to see, for example, what is the impact of inflation on your pot, or the difference it makes if you draw more or less from your pot over time. And if we can control the controllables, we can make much more informed decisions and give ourselves the best chance of preserving those all-important pots. And if there is uncertainty overall, for example, about whether the pot is sufficient or how different aspects may affect its long-term value, it might be worth delaying any drawdown until you're comfortable that you know what you have and that it is sufficient for your needs. Or really importantly, if it isn't, then what can be done about it?
Martin, we've actually had quite a few questions come through about inflation and other external factors that could affect people's savings, and we'll come on to that in a bit. But for now, what do you make of the new variables that have been brought on by the pandemic specifically, in the way that that could be affecting the spreadsheet that Charlotte was speaking about when people are considering what they have to account for as they go into retirement?
Well, on the point of affordability, I mean, I think you would start from the position that everyone can afford to retire. It's just a matter of how many sacrifices you'd have to make to do that. I mean, at the extreme, if you wanted to live in a camper van and live on your state pension, as it were, it's a choice that's available to you. So it is possible, but it might be painful to adjust the level of your living expenses quite radically according to where you want to get to. What you don't want to be is stuck in a middle position where your expenses are high, and if we do have a bout of inflation, your expenses are getting higher, but you haven't arranged your finances in such a way as to be able to see forwards as far as you can see that you're going to be able to afford the lifestyle that you want. So you just have to make some choices, and at a certain point, you have to do that very actively. It's no good sitting on too many assets that are not paying you an income, but that are costing you money to run. You know, if you can't afford to keep the polo team and the chalet in Chamonix, well, they've got to go. You know, but you can adjust down to a viable lifestyle with the income that you know you have ahead. I don't know whether that quite answers the question about variables. Did you have a particular variable in mind? I'm sure we're coming back to inflation. Inflation is a serious problem and serious risk from a retirement point of view, because for many people, the income they look forward to in retirement is not inflation proof, and their costs may well be rising. But we can discuss whether the inflation is a blip or a permanent shift. That's an economic question. No doubt, Kate, you have a view on that.
We can certainly come back to that. Martin, do you think that job insecurity is also affecting people right now, especially in older worker groups? We've spoken a lot throughout the pandemic about young people being hit, but the over 55s have taken quite a big hit in the job market as well. And of course, the furlough scheme is still in place, but unfortunately, we know that more people are going to discover that their jobs no longer exist as that furlough scheme is whittled down into the autumn. So that could be another variable that a lot of people will be thinking about right now that they weren't really considering a year and a half ago.
Yes, of course, job insecurity is a factor in this. I think we don't need to over-egg that, in a sense that I think the job market is going to come back pretty rapidly after a peak of unemployment perhaps in the third quarter of this year, and that unemployment will affect much more younger people in lower paid jobs, hospitality sector and others, than it will as it were, professional middle classes who've probably been able to work from home and so on. But I think the general context that we're talking about tonight, and Charlotte and I think both talking about the same thing, is that to be well prepared for retirement, you need to become the captain of your own financial ship at some stage in the sort of second half of your working life. You have to go through that holistic framework process I described, and begin to set up the structure that's going to see you through into your retirement. And that is increasingly disconnected from whatever job you might be doing now. If you're lucky, whatever job you're doing now will have some pension rights attached to it, contributing into a pension pot. Almost certainly now a defined contribution form of pension pot. Maybe you've already got a SIP or a personal pension arrangement, maybe an amalgamation of pensions. There are businesses that'll do that for you. But I think being independently set up and aware of all these factors is absolutely vital, because the job for life has gone, as I said earlier.
Well, Charlotte, let's pick up on Martin's note of optimism. It looks now like we're just over 12 months on from a record stock market crash, and things largely appear to be back to normal. So can we finally relax?
Well, it's a crazy thought that we've just lived through such an extraordinary global event, and yet stock markets are either back above or close to their levels pre-pandemic. However, I wouldn't suggest things are back to normal. We've had an enormous amount of fiscal and monetary support, which has led to huge debt burdens in countries like the UK and the US. And there are very real concerns about how this will be paid for. Will taxes rise? Could there be hyperinflation? Will there be increasing deglobalization as a result of the pandemic? And of course, how will all of this affect portfolios? However, the question you asked is whether we can finally relax. And I do think that investors should put themselves in a position of being able to be confident about their long-term plans, even if maybe not always relaxed. And one simple way to think about this is what I call the three-pot theory. Broadly speaking, we all live with three financial pots. We may not call it that, but we have a first pot, which is the liquid pot. And that's where, for example, our income comes in, our salary. We might have dividend income, maybe rental income. And out of that pot go our daily living expenses. And then at the other end of the liquidity spectrum is pot 3, which is the illiquid pot. And that's where in the UK, it basically always starts with our home. And if we're lucky enough, it may be homes, or we may have buy-to-let portfolios. Or there'll be other areas of investments that we enjoy. So it might be private equity or direct investments. It could be classic cars, fine wines. And sometimes I call that the passion pot, in fact, because that's the area of investing that we tend to spend time in and enjoy. And we forgive those assets if they're maybe illiquid or have high friction costs, because we enjoy them in the meantime. And then hopefully over the long term, they also produce some decent returns. Now, in the middle of those pots is pot 2. And this is where we should be able to drive what I call sleep well returns. Getting back to this point about how relaxed you can be, we should be able to find a way to have the core of our investment strategy invested across a globally diversified set of assets, and for it to be done in a way which is low cost, transparent, and flexible. And if we're able to do that, then we have a really nice balance between those three pots. And it feels to me as though if we can achieve a point where investors can relax by taking the heavy lifting off them, then that's a fantastic thing to be able to do and still be able to retain a large degree of control and transparency. So I think it's there's no question we're living in a time when there's still a lot of uncertainty. But going back to this point that investing happens over long periods, I think there's a nice way to be able to kind of construct this idea of the three pots, work out which bits you do yourself versus which bits you have someone else do for you. And at the core, really try to deliver those sleep well returns to get you back in your armchair or wherever you find relaxing most helpful.
Well, speaking of control, Martin, given that it's easier than ever to invest for yourself, is it not now a bit old-fashioned or unnecessary to be paying an expert to manage your money?
No, not necessarily. It depends entirely on your own temperament and level of interest in investing, I think. One thing I would say is, even if you're a very enthusiastic private investor who likes to sit and, watch the market for half a day, you still need a sort of best friend, really. There's a sort of old-fashioned concept of the family solicitor or the sort of man of business, in a sort of Goldsworthian Forsyte saga sense. Somebody who isn't, your immediate family, who gives you advice, and particularly actually on tax issues and inheritance issues, that kind of thing. You need somebody else. You do need an expert, even if you want to do the fund management for yourself. But then next question is what is your level of enthusiasm? So if you're really not that interested at all and you're pretty low risk in your outlook, frankly, you might as well entrust your money to a reliable, respectable wealth manager. Don't expect dramatic performance. You probably best not to pick one who has a very didactic view, that wants to put all your money into gold or Japan or some other particularly strong idea. You want the diversified, probably global portfolio that Charlotte referred to, and you shouldn't expect it to do much more than track the indices, but your money isn't going to be lost. If you've got a slightly higher level of interest, you might, for example, start to build a portfolio of good investment trust kind of investments, which are themselves diversified, but you can pick sectors, you can pick parts of the world, and so on. And if you're really keen, then you do it yourself, but that means you have to watch the market day by day, or at least week by week. What you can't do is pick your portfolio in a blaze of excitement and then forget about it and then come back to it later and find it's all gone haywire, if you see what I mean. So it depends very, very much on your temperament and your interest. And frankly, if your interest is low to medium, then a good wealth manager will be worth a modest fee. And on the subject of fees, which Charlotte talked about, that whole area is much more transparent now than it used to be. But you do need to scrutinize carefully what fees you are paying.
Well, Charlotte, you were talking about some of the unknowns and the uncertainties that still loom, given what we've seen with monetary policy over the past year. If we are going to see resurgence in inflation, how can savers protect their portfolios?
Yeah, I mean, there's a lot of talk about inflation currently, and one of the key drivers for markets is the inevitability of a pickup of inflation in the US, where last month's figures show that in April, the market expected year-on-year inflation to be 3.6%, and it was actually 4.2%. And in the UK, the most recent figures contributed to a still significant change to 1.5%. And this is against the backdrop, as we said, of significant monetary growth last year, which has led to a much greater focus on inflationary pressures, and it will set the tone for markets. To understand how expectations for sustained inflationary pressure is being priced, we can look at different market indicators. So, for example, the inflation swaps market is pricing in slightly higher prices than has been the case in recent years. And this is true particularly in the US and also the Eurozone, while the UK position is a little bit more stable at the moment. Nevertheless, we do need to think about whether this is a discontinuous change in the environment for inflation. And if it is, then actually some of the classic inflation protection assets, such as inflation-linked government bonds, could already start to be looking expensive. Commodities are another asset class to consider in an inflationary environment, and we have seen robust increases across the board in energy, precious metals, and agriculture. And we actually captured some of this strong price growth by investing via cyclical positions in commodities in March. But commodity prices are driven by many different factors and can be highly speculative, which is why we're actually very careful not to hold strategic positions in commodities over time. The inflationary pressures have a more direct impact on fixed income assets, and actually a number of people have written in to ask about that. And there are parts of the bond market which have already reflected some of that pressure. We still believe that fixed income does have a home for certain lower risk portfolios, but it is an area that we reduced our exposure to in March and that we're watching very carefully. Equity markets, on the other hand, can be quite resilient to inflation, and performance has been broadly stable over the past couple of months, despite the fact there have been increasing inflationary concerns. A key factor behind this resilience has been the recent earnings season in the US and Europe. And the US earnings season in particular was very strong, with many companies beating what were already high analyst expectations. I think it is worth exercising some caution, though, looking at these numbers, because the investor relations teams tend to be very good at managing expectations for the market. But the numbers that they're reporting are much higher than is normally the case for both the US and Europe. And I think that leads on to potentially the bigger challenge for investors, and that is one of valuation. The high expectations of future performance are already being built into asset prices, particularly in the US. And for now, we're happy that this earnings growth will be sustained, but it is something that we're monitoring incredibly carefully since it's a lot higher, both versus other markets and also compared to US history. And we expect that these high valuation levels will continue to dampen future returns within the market over the longer term. And that's why our expectations are actually reasonably modest in terms of how we think markets are going to perform over the next few years. One last point is just to go back to the fact that retirement is a long-term event, if that's what we can call it. And there are assets that investors can introduce to their portfolios to dampen the effects of inflation, as we discussed. But it's worth remembering that these periods are, relatively speaking, quite often short-lived. So while it's not yet clear how well or if we'll avoid much higher inflation, and our own view, by the way, is that we'll be moving to a higher but still relatively low inflation environment, as a rule, we can expect these periods to be relatively brief in the context of an investor's overall retirement years.
Martin, what do you think? I'm not going to ask you to make a direct prediction about what's going to happen to the headline rate of inflation, but given that so many people are increasingly concerned about inflation rising, what would your advice be to savers to protect their portfolios?
Well, Charlotte's run through most of the pointers on that. I'd add to that property, real property, even buy-to-let flats might be a bit out of fashion, as it were, but real property generally has kept pace or done better than inflation for a long time. Farmland, woodland, that's a very green way to go with your money. Are worth looking at in the commodity sector, sort of ETF type products that would get you into precious metals, commodities, but also big blue chip mining companies right now would be the sort of thing. But on the whole, over the long term, blue chip equities and property basically will stay up with inflation.
I want to move on to the questions coming in from our audience. I can see that we have lots coming in this evening. I have some that have been pre-submitted. Just a reminder, if you would like to submit a question to Martin or Charlotte or both, you can do so through our website in the text box. You can also email events@spectator.co.uk. But before I make the switch, Martin, let me ask, this isn't a question that perhaps we would have asked even just a few years ago, but I think it's hard to ignore now, this topic of cryptocurrencies. How should a sensible investor look at something like Bitcoin? Is there a role for these cryptocurrencies to play in the portfolio?
Well, so in Charlotte's 3 pots, I have a similar sort of little diagram on my notes in front of me. The 3rd, 4th, or 5th pot, the very last pot, the one you absolutely just take a wild punt with, is the one you might take a bet on cryptocurrencies. Don't for a single moment. Now, I know I disagree with some Spectator readers because they corresponded with me in a very agitated way on this subject, but I would regard a cryptocurrency as a gambling chip, a very short-term thing to go into. It was going up and up and up. It's crashed by 50% recently. It's extremely volatile. No one really understands what the hell it is. But it's a gambling chip. And if you want, with the last 5%, 1% of your liquidity to have a punt on it, well, best wishes and have a go. But don't in any sense think of it as being a core asset for your retirement plan. Charlotte, do you disagree?
I couldn't have put it better myself. I mean, it's one of the reasons I talk about pot 3 as being the passion pot, because you have to be pretty keen on something like a cryptocurrency to want to, risk some of your money in speculating, which I think it can't be described as anything else. On the other hand, as you were saying before, Martin, I mean, there are many people who enjoy a bit of investing and sort of, having a punt on something. And there's no reason why cryptocurrency shouldn't be among those things. And some people will have done very well out of taking some of those positions, but I certainly wouldn't put any, significant amounts of money to work in that area.
And I mean, if you compared it with investing in fine wine, for example. I mean, fine wine is fun. It probably goes up over a long period of time, but there is a risk that you'll just drink the stuff and there's nothing left, if you see what I mean. There's a similar risk that a cryptocurrency may simply evaporate in cyberspace and not be there at all, but let's not go into that.
Well, arguably, you're getting more out of the fine wine in that set of circumstances. But you both described it as a punt. Charlotte, let me ask you: do you think that position could change in time if, as we're seeing, cryptocurrencies become more and more entwined in the mainstream financial world?
I think it's something that could happen. I think we're a long way off it happening still. I mean, the whole question around blockchain, which is, what Bitcoin is about. So trying to take out the middleman, take out the banks, and take out those intermittent charges that we all suffer from at the moment by going through the sort of more traditional routes for sending money from A to B. I think the idea behind it is interesting. And over time, I suspect it will become more mainstream, but it isn't something that I would make part of my sort of core investing philosophy for now.
Well, I mentioned that inflation was coming through as a big topic in our questions, and I'm going to move to questions now. Another one has been about taxes and potentially a tax raid that could be coming down the line, given how much money we've spent and how much we've increased that overall debt figure in the UK since the pandemic began. And Ben has asked this evening, is there a danger of a wealth tax targeting homes that are used for primary residence, and how might this affect people's plans for retirement? Martin?
I think there is a pretty slim chance of any form of direct wealth tax. So we do have a Conservative government, Conservative Chancellor of the Exchequer. He was clearly looking at raising capital gains tax rates and perhaps bringing them into line with income tax rates, which wouldn't frankly be all that radical and would raise a bit of money. And he even backed away from that. But I think it's pretty well unthinkable to bring in a direct wealth tax where you're taxed a certain percentage of the value of your assets, whether you're selling them or not. Under a future Labour government, who knows? In the States, there is vague talk about Biden taxing wealth, but what that means is higher income taxes and capital gains taxes. There, in other places in France and elsewhere, there are the beginnings of wealth tax systems, but it's not part of our sort of discourse and vocabulary at the moment. And so I don't think it's a real risk. And on the whole question of tax, I mean, I think there could be some tax rises that do sting the middle classes and the higher earners and the people with the better pension incomes that are coming in. That is true. But as I said earlier on, if you have taken the fullest advantage of all the tax breaks that are available for saving for retirement, then probably the advantage is on your side in any case.
Charlotte, as Martin mentions, the Chancellor seems to have rolled out wealth taxes so far, but is this something that you would advise people to be thinking about planning 10, 20 years down the road?
Well, it's really interesting. I mean, tax is a question which does come up a lot. And obviously, there's been a lot of saber rattling on the topic over the last few months. I would agree, actually, that it seems to me the Chancellor has more room for manoeuvre than we might have thought. And there have been, these seemingly obvious areas of low-hanging fruit for the Chancellor, which, one, as Martin was saying, is equalising CGT with income tax. But the truth is that many of the tax fixes that are being discussed would have a relatively meaningless impact on the Treasury's shortfall and would also alienate a large number of people in the meantime. So I expect there will be tax changes at some stage, maybe CGT. I actually think there may be some form of wealth tax, for example, although, there's plenty of time to think about what form it would take. But one thing that's really important to remember is that when changes are brought in, it's almost never overnight. So in other words, there's usually time to digest whatever changes are announced and then do something about it. And then, I mean, one final thing I would add on this topic from my side, I'm always amazed at how many people allow the tax tail to wag the investment dog, so to speak. I mean, a classic example of this is where a position with significant capital gains is held in a family or is passed on between generations. And there's such reluctance to pay tax that the positions are kept. and they're kept regardless of the fact that maybe the stocks don't offer strong growth potential anymore, and the fact that CGT is actually still relatively low at 20%. So in the end, it's better to go about your financial planning in the broadest sense, where tax is clearly a consideration, but among other things, it shouldn't define everything we do. And I think it can cause us to make decisions we might regret if it's the main driver.
Charlotte, we've had a question through from Edward, who's asked how you would compare the tax advantages of an ISA to a self-invested personal pension. Can you give some insight as to where you think the best advantages lie right now?
Yeah, I mean, both of these tax wrappers are great things to have. I mean, the ISAs, you're able to put in £20,000 per adult, and now junior ISAs as well, the limit has been raised to £9,000 per child. So for anyone in the family below 18. So in fact, for a family of several people in it, you can every year put in what can amount to a pretty significant amount into the ISA or junior ISA wrapper, just remembering that anything you put into the junior ISA does belong to your child as and when they're 18. So, and of course, the same is true for any money that you might put into an adult child's ISA, the £20,000 limit every year. But you can put together really quite nice tax-free positions through ISAs. The nice thing with ISAs is that the returns accumulate tax-free, and you've paid money on the tax that goes into the wrapper, but thereafter it's tax-free. The difference with a SIP is that you accrue that over time, and you're actually putting in untaxed money. It's the government who will gross up whatever amount you put into it to effectively be gross, and then it is taxed when you take it out at whatever your particular tax rate is at the time. I think both, if possible, are very important to contribute to. And there are different reasons for that. I think one thing to remember about pensions in particular is that they're a very useful planning tool for inheritance tax because they fall outside of your estate from an inheritance tax perspective. So it's quite interesting for us, actually, as we work with families who have over time put together ISA savings, they've put together pensions, they've accumulated pensions over time, and they've also got their sort of taxable accounts. What's quite interesting is to then think about how do you work with those different sort of tax-free buckets, if you like, and then the taxable bucket in the context of how you work with that in retirement. Because in fact, the decisions you make in terms of which of those pots you draw from first will end up having quite a significant impact potentially on how much is left at the stage that you're no longer there, and the tax consequences of whatever's left. So pensions are a very important tool when it comes to overall tax planning. And in the meantime, as I said, I would always try to fill up my ISA bucket as well every year if that's possible, because again, they're a very attractive tool. The really nice thing with ISAs that I didn't mention is, of course, you can also take your money out whenever you want. So you do lose that tax-free element once you take it out, but there's nothing to stop you taking it out whenever you need it. So they're very useful if you're trying to save up money tax-free, and then you say in 5 years' time you need it to put down a deposit on a house, for example, whereas your pension you can't access until 55.
Martin, Natasha asks what you think the balance is between those wanting to work longer and those who are needing to work longer. I suppose another way of putting that is, what is the right time to start making these plans and thinking about what you want your life to look like when you reach retirement? Because you don't want to get to the point where you almost feel as if this decision about wanting to work or needing to work is out of your hands.
Very interesting question. I think it's sort of intrinsic, isn't it? I think people just know. You can't know when you're 30 or 40 how long you want to work for, I don't think. You could say conversationally, I'm sure I never want to retire. But only, I think, when you reach a certain point of maturity, perhaps your children have flown the nest finally, they're no longer a financial burden on you, your health may start to change, deteriorate in some way. Things creep up on you, probably in your mid-50s onwards. You begin to see the choices ahead of you. But I think something will tell you, perhaps your spouse will tell you, perhaps your body will tell you when the time to retire is going to be. But on the whole, because most of us nowadays don't do the kind of hard physical work that many of our forebears would have done, we are well cared for, well medicated in lots of ways. People's hearts keep going and so on. So I think most people are well capable, physically and mentally, of going on into their late 60s, perhaps into their 70s. And we see many, many vigorous people in the business world, in the political world, who have absolutely no intention of stopping. And this isn't a sort of self-help Prince Harry style workshop. But what I would say is it's a very healthy thing to keep working. So if you can do, and if you don't want to work to earn, work to do something else, work for charity, work for a project, do something really active that you've always wanted to do. I don't know if that answers the question. It's certainly not a financial answer, but I think nowadays we have the great good fortune that we can, and largely physically we are capable of going on well past what used to be thought of as normal retirement age.
Charlotte, what are your thoughts on this?
Well, I mean, I would agree with a lot of what Martin has just said. And I think, one of the interesting things as well is that technology is very helpful in allowing us to work in ways that we might not have done before. So, I mean, just take a look at what's happened over the course of the pandemic. We've all suddenly become much more used to being able to do a huge amount from our home office, for example. And that might well mean that for people who had thought they would retire because they don't want to commute anymore and it's getting quite tiring and, they'd like to see more of their spouse or whatever it may be, actually, if we can now work much better from home and the hours that we work as well can maybe be mixed up a bit more. We might go out and, I don't know, feed the chickens and then get back to the desk a bit later. So I think the very fact that what work even means has been changed so much, and technology allows us to be so much more adaptable, that I think it's actually a very exciting aspect to how we think about approaching older age and how we want to spend our time. And I quite like the fact that it doesn't need to be anything like as binary as it has been before. It isn't a question of it's 5 days in the office or nothing. There are going to be far, far greater potential to be flexible. And I think that this may be particularly important for women, actually, whether it's a question of how they come back to the workforce after having had children, or if they're, for example, having to think about taking care of elderly parents, then there will be all sorts of reasons why there's an ability to stay involved in work and be part of the workforce, whereas before that would have been much more challenging. So I think, it's really quite exciting to think about what might be possible in the years to come.
We've had quite a few questions through asking for some practical advice. Christian says he's 58 years old, and he's wondering what the best balance is for his pension fund, looking at equities, bonds, cash, gold, etc. What's the best balance, and specifically, what's the best long-term bet, he asks. Martin, what are your thoughts?
I think the conventional answer, I'm going to defer to Charlotte a bit on this one. This is a bit technical for me, but I think the conventional answer to that is, as you move towards actual retirement age, wherever you set that to be, you probably want to be more moving from equities towards fixed income in the makeup of your sort of core portfolio that is actually going to secure your future. I go back to my first answer, really, which is to create this framework in which you know what all your assets are and decide which of them you want to keep in their present form and which you might be able to change to a different form. So I think if you're at the point of retirement, it's an extraordinarily sensible thing to do to look at your house and think, could I live in a smaller house if I released £250,000 of equity out of this house, which is bigger than I need to live in? That's £250,000. I could do a lot of sensible retirement planning things within the financial arena. But really, I want to defer to Charlotte on that question, if I may.
Of course, Charlotte.
Yes, I mean, one thing I should say is that we're not able to offer financial advice per se on this panel, either Martin or myself. But the questioner, I think, is 58, and that's actually very young in the context of how long a retirement might last. So one of the things that is definitely worth making sure of is to make sure that those retirement assets, the retirement pot, is invested. There has typically been this idea that as you grow older and as you approach retirement, you would want your pot to be more in fixed income assets. I would think about it a little bit differently. First of all, just remember that just because you retire, it doesn't mean that all of a sudden there's only now another 5 years for those assets to last. They need to last probably another 30 years in the context of the question of this evening. So I would say they need to remain invested in, again, diversified, as we've talked about before, in order to avoid, specific idiosyncratic risks. So to remain invested in a globally diversified portfolio of principally equity assets, and expect that that will be the case over a reasonably long period until, approaching much later on in retirement. The other thing that we do, which I see happen a lot, and I really like actually, is to think about what you're wanting from your pension pot. So, for example, for some people, they may be looking to draw relatively early. And let's take, again, the example of someone in their late 50s. So we know that there's maybe a 30-year period that pot is going to last. And we may also know that we want to start drawing quite early on. What I would do in that situation is actually split my pot into a couple of different places. And I would have one part of it invested in much lower risk assets, which are the more likely to be fixed income dominated, therefore less likely to be so volatile. And that be the pot that I draw from over, a defined period, let's call it 5 years or 10 years, and allow the balance of the assets to be invested in a much more equity oriented set of investments, and therefore really allow it to kind of earn the market and to make more significant inflation plus type returns, so that at the point you have used up that first more conservative pot, you've got hopefully a bigger and enlarged pot to work on for later on in your retirement.
We've had a great question come through, which I suppose on the face of it is simple, but I think I wouldn't even know where to begin. Martin, what is the one big thing that somebody can do to make the most difference to their retirement age? And I think by difference here, the implication is better, more fulfilling, and probably more stable.
To make a difference to their retirement
age.
Yeah,
what's the one action, whether that be forward planning or certain kinds of investment? What's the one thing that somebody can do to make their retirement age more comfortable?
Well, I think Charlotte, right at the beginning, talked about uncertainty and living with uncertainty. So a rather boring answer to that, but it's a solid answer, is you have to be sure that for the rest of your life, there is at least a block of your assets that's producing, and pensions, entitlements, and so on, that is producing an income that will allow you to live at a level you can be happy to live at, if you follow me. So you have to adjust your lifestyle and arrange your finances so that if you feel the figure, you may be able to put a number on it, you may be able to put a sort of physical description on it. The physical description may be, I would like to live the rest of my life in a small cottage in the countryside, and I'll be very happy growing my own vegetables, and what I need is an income that will fund that. And I guess that income might be, let's say, I don't know, £30,000 net of tax per year, ignoring inflation, for the rest of my life. You may have higher aspirations, bigger things you want to do. You may want to put a bigger number on it, but you've got to do the sort of framework exercise that I described, and you've got to put in the low risk building block that matches the sort of lower end of your aspiration of how you want to live. That's not an exciting answer, but that's the best way I can describe it.
Well, Charlotte, Martin's given, I think, a very solid answer of finding certainty. What would your answer be?
Well, aside from, sticking it all in Bitcoin on exactly the right day and it tripling in value by the following day, assuming you can then get out of it and sell it again, which obviously would be one way to ensure a very nice retirement. There's something else that to me is absolutely clear for that question. Martin mentioned earlier that one thing you really can't do much about is the markets, and I absolutely agree that across people managing wealth for people, there is fairly similar results. There are fairly similar results in terms of what the investment returns are, and yet people spend a lot of time worrying about should it be this, should it be that. And ultimately, I think the net result is not that big. I'm going to go back to a point I made earlier. The single biggest way to help ultimately what that retirement pot looks like is actually cost. And it's interesting. I brought up the example of paying 1% every year more than you need to. If you think about how so much we hate the idea of a wealth tax, and you think that wealth tax might be 1% a year on our assets. That sounds absolutely appalling. Well, the truth is lots of people are spending or paying 1% more on their investment assets than they should. And that is a wealth tax, but rather than it going to the Treasury, it's going to a wealth manager or an IFA. So the impact of spending too much in fees is really important. I can't overemphasize it. It's probably the single biggest aspect that will, make that difference to your retirement pot.
We are almost out of time, just a few minutes left. So I'm going to squeeze in one last question from our watcher tonight. For somebody who is on a lower income, what advice would you give when it comes to saving? Are there any tips, Charlotte, that you might have to make sure that person is able to put away a bit more money to make sure that they're going to be okay in retirement?
Yeah, I think this comes a little bit down to this idea I talked about at the start of a personal balance sheet. So if you're on a lower income, to some extent, there's not much you can do if the income you're on, you need to use, every last penny of it. But I think for most people, if they think very carefully about what their outgoings are, and they think about where potentially they need to tighten their belts, but they really start to think, okay, how much can I put aside every month? And they start doing that as early on as they can. And then they make sure that money, which they're not intending, then to spend or to use, they're intending for that to build up for some time in the future, that money they invest. Because one of the things that we all tend to do too often is we tend to keep money in cash. So we think we're building up this nest egg. And in fact, what we're doing is we're building up a block of money that in the end is just going to be eroded by inflation. So for someone on a lower income, particularly if you can afford to put some money aside, then do it. Don't leave it in cash, invest it. And then think quite carefully about, would it, for example, make sense to do ISAs? I mean, it depends again on how much tax you're paying, but if you're paying tax, they do make sense. And then it's important, to the extent you do make those types of investments, make sure you're not being charged to make them when it's not necessary. So just going back to the point about ISAs, it's pretty interesting. Some groups charge you to do an ISA. An ISA is simply a tax-free wrapper, and it is free for people to use, and then you will end up paying somebody for what goes into it, in terms of the actual investments themselves. But I think, to come back to the question, little and often is important, and to make sure that if you possibly can, you invest over that long-term time frame, and your money will grow, and it will help to build up into something for you for the future.
Martin, last word to you. Any saving tips?
Well, all I'd say, in addition to all that very wise advice from Charlotte, is early in life, I think it's still pretty sound, as it was for my generation, that the first thing to try and do is become a home owner. Your home will always stand you in good stead. It will It will beat inflation. It will be there to sell, to cash in, to downsize when you need to. Secondly, stakeholder pension. I did one of these, 25 years ago. I forgot after a while that I was putting, I think, £240 a month. The government grossed it up to 300 in the pension pot. When it came through as a pension for life that's roughly £240 a month. Guess what? But the fact is that equates to something like a £500 a month advantage in cash flow terms. I stop saving, I start receiving the income. That's a terribly simple thing to do. ISAs are a very simple thing to do. And if you've got that sort of money, you'd be foolish not to do as much of the ISA allowance every year as you can. So those are simple building blocks relatively early in life. Anyway, good luck to everyone with their retirement planning would be my last word.
An excellent last word. Well, that is 7 p.m. on the dot. Martin and Charlotte, thank you so much for joining me and providing your wonderful insights to our watchers tonight for our event Securing Your Future. Thank you for joining The Spectator, those of you watching at home. And once again, thank you to our sponsor, Netwealth. Have a wonderful evening.